right now, the worry is if we go back there, we could trigger inflation and make our job so much harder. They're not understanding, and I've said this too, is I don't think there's anybody in the FOMC or anybody in the Fed, frankly, that really understands the magnitude of the risks this time around. It's really that debt and derivative story, because leverage can have things happen much faster. And then when you have that kind of leverage, that magnitude of leverage, it can make things so much greater. I don't think anybody's thought through that and understands. I think they think 2008-9 was a one-off, and that yes, we have risk that it could be something like that, but less. But I don't think anybody's really understanding how close we are to something bigger than 2008-9. And so if it's not even in their mind as a possibility, it's not among their scenarios, they're thinking the risks, he says this all the time, risks are balanced, We have to worry about tipping us into recession versus worrying about inflation breaking out a bit. You have no idea. We see your worries. It's so much bigger than that. And he's not going to, certainly in the next several months, he's not going to understand, because the markets are going to be looking like things are okay. And frankly, Powell gets a lot of heat, and I defend him on some of this only because I think people have to step away and realize he's saying the same things that the vast majority of Wall Street economists are saying. They weren't pushing for rate cuts here either. I think Powell is late. I think the Fed is late. They should be easing now. But he's not the only one thinking that they don't need to ease. There's no rush. Things look okay to most Wall Street economists. And yet we may be just months away from something that ultimately becomes much bigger than anything we've ever seen. I get timing off all the time. These are big cycles, and I can be wrong by many, many months. But if I'm right about my guess of when this thing really gets going, it's probably first quarter of next year. So he'll be dealing with it before he leaves his position, I think. Then he'll be handing it off to somebody else, and the biggest part of the money print will be probably under somebody else's leadership. So keep in mind, the U.S. is not operating the Fed's not operating in a vacuum here. It will be proportionally the same story with every central bank. This is a global bust. They'll all be printing at, breakneck speed once they realize they have no choice. Again, I think it's not just Powell. All the central bankers, to one degree or another, are going to be cautious about printing, so they're all going to be behind the curve for a while, and ultimately then have to really race to catch up. And that's when the money starts pouring out. But it's still ultimately the story of all that money. Let's say it's 100 trillion. I don't know what it's, 50 trillion is way beyond anything this world has ever seen by magnitudes. The story is it jumpstarts a recovery for sure, but it also jumpstarts inflation. I think the bust will be deflationary because we're going to be entering the bust at very low single digit inflation. So we probably almost definitely go into deflation for a year. And then coming out of that means the first year out, despite all that money, you're probably in low single digit inflation. Second year, maybe high single digit inflation. By the third year, you're in double digit inflation on your way to, I think in the US, you could see 25% inflation by early 2030s. So the ramifications are huge because rates follow inflation. So if we're going to be looking at interest rates going from zero, and I'll just talk the 10-year, short rates could be negative, or most likely going to be negative, but you go 10 years zero, and within, say, 6-7 years, you're looking at, 10-year maybe approaching 20%, and maybe in less time than that even. So we're still going to have the debt. We're still going to have governments having to finance, having to service their debt. And my guess is, I talk about the money, but it's going to be both fiscal and monetary. Obviously, it always is. The Fed will be monetizing new debt. The Treasury will be issuing new debt. They'll be doing all kinds of programs like they did in 2020. And so, the Fed will be buying all that debt, monetizing that debt. That means we're at 37 trillion now in U.S. government debt. It's probably going to be north of 50. If we're at 330 trillion now, global debt, both sovereign and private, corporate, it's probably going to be something approaching 450 to 500 trillion. A lot of that debt's going to have to be serviced and refinanced, et cetera, at higher rates. And, just sticking to the U.S. government, there's no way you can solve that equation if you're looking at interest rates in the double digits and your debt is where it is. We can't service it at 5%, right? And it crowds out every other thing you can do in the government if you have to. Ultimately, I think it leads to, again, again, not for several years, but probably by 2033 to 35, I think it leads to a collapse of the financial system as we know it. So the Austrians might believe that this is the end game now, and that we, heading straight south from here. I believe that we have one more cycle because we have the printing press. As long as you have inflation near zero or below zero, you can print money almost to infinity because there's a lag to when that shows up as inflation. So for the next, when the bust hits, for the next 18 months after that, you have the ability to print money to whatever level you need to. And that's why it's going to grow to what it is, because, they're trying to stabilize the system. But then once it happens, there's nothing you can do because you've waited way too long to back off of that. And once that inflation starts heating up, you're not going to be able to stop it. They're going to fight tightening because tightening means higher rates at a time when they can't afford the rates that they're going to be dealing with. So they're going to be slow to tighten. And as I say, you can't print your way out of it once inflation really heats up because it's like pouring gasoline on a forest fire. It just makes more inflation. So basically they run out of options next cycle. This cycle, they have the printing press. Next cycle, there will be no options left. Let's start with getting from here to the next recovery cycle. So you go into this bust, you have to be very aware that, from the mid-'80s on, the mantra in the financial industry was, it's time in the market, not timing the market. And that was correct all the way through. It didn't take any genius to put your money in an index fund, and you've probably outperformed most professional money managers in the last 40 years. If you bought back in the mid-'80s or any time since and put it in, the index fund, the S&P index has outperformed active management typically. And that's because we were in a period of disinflation where interest rates came down, PE multiples went up, earnings did great, and indexes did great. Going into this, if you listen to your financial advisors, because they're not going to say anything otherwise now, they're going to say, oh, don't bail out. Markets always go to new highs. If you just ride through these things, you come out the other side and you do fine. And they've been right through all these cycles since, mid-'80s. The problem is that if we're going down 80% or anything close to that, I think the highs this cycle that we make later this year, in my opinion, will probably stand for decades. And obviously, if my dire forecast comes true in the mid-30s, it may be many decades. So it's going to behoove people to actually go against what the kind of consensus advice out there is and actually liquidate your portfolios or get very defensive, and meaning in cash and bond. Treasuries will be one of the very few assets to hold up in the bust. If interest rates go from where they are now to zero, holding a long bond is going to be very lucrative. So you can hide during the bust, but it's not in equities. You could say, well, I'll be in defensive equities like utilities. Well, they're not defensive anymore. It's so much anymore. And frankly, they'll go down less than the market. But if the market goes down 80 and they go down 40, you're not going to be a happy camp. And, same thing with consumer staples and things. They may go down less than the market, maybe not, but they're not going to preserve your capital. So preservation of capital somewhere later this year is going to be very important. And I should point out, because time-wise, we may not be very far from a top. So normally my own advice would be, nobody's going to call the top. Don't try to be a hero. If you're out 6 months early, you'll be grateful you're out. The problem is, if we're looking at 30 to 50% upside between now and the end of the year, that's typically 3 years worth of returns at least. And so even though time-wise, it's time to say, hey, I'm not taking any more risk, I'm getting out, you're going to be very unhappy if you get out now and miss 30, 40% upside. And then investors that come out today are almost sure, majority of them, to be drawn back in at the top. Because at the top, there's not going to be a bell rung. At the top, most institutions that have been skeptical all the way up are going to be screaming that this thing has a long way to run. We just started a new Fed easing cycle. There's at least a couple more years to go. And so if you got out now, you're going to say, hey, I can't afford to miss more of this upside. I just missed 30 or 40%. I got to get back in. I was dumb to get out. And then what do? You just climb back in at the top. By the way, metals that people think are good defensive things, they're likely to get hit pretty hard. I think it's going to be hard to find many assets that don't get hit hard in a bust. So certainly silver is an economically sensitive metal. It could go down almost as much as the market, 50, 60, 70%. Gold may hold up better because it is something that people run to. So it might only go down 30, 40%, but it's going to go down. On the other side of the bust, this isn't the end end of making money in markets or the end of opportunities. I believe, just looking at the US, if you look at something close to 20 trillion in new QE, and even if I'm half right, it's only 10, you're looking at a V bottom at some point. So if you go down 80%, you can come back 3 or 4-fold from that. So let's just use 9,000 as an S&P estimate for a top. 80% down gets you to 1,800. You could see the market go up, let's say, 4-fold from that, and that's 7,200. If we peak at 9,000 and go back to 7,200, you're in a secular bear market if that's your high for the next cycle. But you also had a 4-fold increase out of the bottom. So those that think it's the end of the day here when we top out, no, there's another cycle after this one, and there's going to be plenty of money-making opportunities, and most importantly, going to be a lot of opportunities in commodities. This cycle, was led by tech, and up until a year ago, healthcare and, some other things. The next cycle will be a commodity cycle. With all that money printed and with the reshoring going on and, more of that to come, you're going to see that it's industrials and commodities that will dominate the leadership in the next cycle. I am forecasting oil to go to $30 in the bus. And I think I've been the only right bear out there calling for, I called low 60s when it was over 100. So I think 30 in the bust. I think you could see oil at $500 by the early 2030s. So energy will be a dominant leader. Copper will do very well. Any of the industrial metals will do well. And the precious metals will probably top the charts. I think gold's going to 20,000 by sometime in the early 2030s. I think silver's going to 500 in that time. And I may be conservative. I think they can get hit in the bust, as I said. My targets for, by the way, just to square that circle, my targets for silver pre-bust is 75, and for gold, 4,000. So there's going to be tremendous opportunities, but it's not in the same leadership that made you your money this time around. And it's sure not going to be in the indexes. Could be in the indexes for the first year or 18 months coming out of the bottom. But after that, you're going to have a stiff headwind of ever rising interest rates, pushing PE multiples down. So the only things that really work in that kind of an environment, that was kind of the late 70s, early 80s market, is you go into the industries, particularly the commodities, where their price flexibility because of the supply-demand situation means they're able to print earnings or make earnings that stay far ahead of the interest rate gains. So as rates go up, earnings are going up faster. In most of the sectors, earnings aren't going to keep pace with inflation, so your stocks go down.